Life insurance might be the most misunderstood financial product on the planet, and that misunderstanding could cost your family everything. We're talking about a product that people dismiss over a cup of coffee, while simultaneously carrying a mortgage, dependents, and a mountain of debt they'd leave behind. Here's the irony that nobody talks about. The people who call life insurance a scam are often the same ones who would devastate their families financially if they disappeared tomorrow. Think about that for a second. We insure our phones, our cars, even our pets. But the idea of insuring the human being actually generating the income somehow becomes a conspiracy theory. So why does this product get such a bad reputation in the first place? Part of it is behavioral when money is tight. Anything without an immediate, visible return feels like a ripoff, and life insurance by design only pays out when you're no longer around to enjoy the vindication. The other part is a fundamental misunderstanding of what it actually is. This isn't a savings account, it isn't an investment vehicle, and it's not trying to be, it's a contingency plan. A financial fire extinguisher you hope you never use, but would be absolutely devastated to need and not have. Now let's talk about the numbers that genuinely should make your jaw drop. A healthy person in their 20s can secure 100,000 pounds of coverage for literally 5 or 6 pounds a month. That's less than a single fancy coffee, locking in protection for an entire decade or more. And here's where the guaranteed premium model becomes almost absurdly powerful. The price you lock in at 25 years old stays frozen. Even if you develop health conditions at 45 that would otherwise make new coverage completely unaffordable, you've essentially outsmarted future you's worst case health scenario. Historically, the people who regret engaging with life insurance early are vanishingly rare. But the people who regret waiting are a heartbreaking and very real category. Every financial advisor worth their credentials will tell you the same thing. The single biggest mistake their clients make with protection products is treating them as optional rather than foundational. The misconception we need to destroy right now is the idea that the payout has to be tied to a mortgage. That lump sum is yours to assign to whatever future obligation matters most: university fees, childcare costs, business debts, daily living expenses. It's a blank check written to the people depending on you. And yes, if you outlive your policy term, you don't get your premiums back. That's the part people use to call it a scam. But by that logic, your car insurance is also a scam every year you don't crash. The product worked exactly as intended. You just had the profound luxury of not needing it. The practical lesson history keeps teaching us, cycle after cycle, is that protection products purchased during perceived financial stability feel redundant right up until the moment they're catastrophically necessary. The discipline isn't in believing something bad will happen, it's in preparing rationally regardless of that belief. What the smartest financial minds consistently emphasize is process over prediction. Don't try to time your health. Don't gamble that your income is invincible. And don't let the cost of living squeeze out the one product designed to protect against its worst consequences. Structured, unemotional decision-making on protection is about as unsexy as finance gets, and it's almost always the right call. At a philosophical level, peace of mind is genuinely underrated as a financial asset. Knowing that your family's mortgage, your children's education, and your partner's stability are protected isn't just emotional comfort. It's a form of clarity that lets you take calculated risks elsewhere in life without existential fear hanging over every decision. The window for locking in low premiums is real, and it is closing every single year you age. That's not a sales pitch. That's just actuarial math working against you in slow motion. If you're in your 20s or 30s with dependents or debt, this belongs at the top of your financial priority list, not the bottom of a to-do list you revisit every January. Whether you end up needing that payout or outliving your policy with nothing but decades of affordable peace of mind, both outcomes are genuinely fine when the decision was made rationally and the sizing was right. The goal was never to win a bet against death, it was to make sure the people you love don't lose one. And if you're ready to take that next step, whether it's life insurance planning, real estate investing, home contracting work, or finding the right lenders, check out our links in the description below and let's get you started.